Topic 12 begins today. It deals with sales and purchases, which you've had before, but now we're going to be talking about a new twist to both kinds of accounts. Sometimes customers return things to us, sometimes we buy something and it's the wrong thing or it's damaged in some fashion and we need to return it. So we will be talking about how the accountant handles those situations. Also, you see on your screen a chart of accounts. This is for the ABC Bookstore, and you see the LLC behind it. And I'll explain what that means in just a moment. For the next couple topics, actually, we will be using this company in various ways, dealing with not only sales and purchases, but also other things other kinds of transactions that corporations deal with. The LLC stands for Limited Liability Corporation. This is a specific kind of corporation, typically a smaller corporation, sometimes owned by a family or a small group of people. It's a little different than something like General Motors might be, that is worldwide and it's just a gigantic corporation. This is much smaller in scale. There are some differences with it that we'll take a look at a little later on. So we'll be using the ABC Bookstore quite a bit in the next couple weeks. On this chart of accounts, you see a couple things. First of all, you've had one of these before. I showed you one in an earlier video at the beginning of the semester. You see many more accounts than we've used in the past, and also the numbering system is a little different. Companies can choose to number accounts as they wish, and sometimes a numbering system works better for one company than another. So that's not a hard and fast rule. This one uses a 4-digit numbering system, and you'll see those on the screen in front of you. I want to look at a couple of the things that are important for us. First of all, today and tomorrow we'll be talking about this particular account, 4130, Sales, Returns, and Allowances. We'll see how that works when a customer returns something to us. Also, I want to take a look at right now the assets over on the left. All these accounts on the left side of the chart of accounts are the accounts you would find on a balance sheet. As you see, all the accounts on the right side are those found on an income statement. But I want to look at the assets for just a moment. You have current assets and you have something called plant assets. The basic differences for our purposes would be that the plant assets are those major assets that depreciate. And we had several problems with a delivery truck, for example. This company has one as well. And it depreciates. Over time, it wears out. And so you have not only the delivery truck, but also the accumulated depreciation account. We also have store equipment of some kind just below it. And apparently it also wears out over time, so it must be depreciated. And we have an accumulated depreciation account for that as well. I mentioned those two things because if you remember, when we dealt with these kinds of assets, delivery truck, for example, when we bought the delivery truck, there's an account in the general ledger for delivery truck, and it would be debited by the amount of the value at the beginning when we buy the truck new. And that does not change through the years. Even if the delivery truck may be 10 or 15 years old, that account still has the original value of the truck. The accumulated account, though, keeps track of how much it wears out month by month or year by year. This is so that we can tell by looking at the balance sheet where this will end up that the delivery truck costs us a certain amount of money, and the other account right below it on the balance sheet would show how much it has declined in value, how much it has depreciated. Now that's not new. We've had that earlier, and I mentioned that now because over on the right side, we will be dealing with operating revenue. And you see the three accounts there. And sales works with sales, returns, and allowances in a similar way that delivery truck worked with the accumulated depreciation account. We don't change the sales. When we make sales, those amounts, either cash sales or credit sales, would be credited to the sales account. If somebody returns something, we don't debit the sales account. Rather, we will debit a separate account called sales returns and allowances. When we look at the income statement, then we can tell the total amount of sales, and then also we can tell in a different line, right below it probably, we can tell how much has been returned to us. The owner or the board of directors, the finance people will want to know that to see if that's become a problem with the company. So we'll see how that works in some transactions here in a few minutes. So we have sales, the revenue account. We had sales discounts before. This, as you know, represents a discount in what we charge the customer if he or she pays us early. So we may give a 2% discount if the customer pays within 10 days, for example. That's when this account is used. The sales returns and allowances is used only when somebody returns something and we give them cash or credit back. Sometimes we give them what's called an allowance. So maybe they bought something and we shipped the wrong thing, but they decided they want to keep it. But to show goodwill, we might deduct something from their bill. That would be called an allowance. A little different than a sales discount. So we'll take a look at that here with our journals and ledgers in just a few moments. Also on this chart of accounts, you will see that the stockholders, or the owner's equity now is called stockholders' equity down here, and we've got some new accounts that we will look at in another week or so for this company. And finally, we have subsidiary ledgers, and we've got a bunch of customers that you may have seen before, and you've got a list of creditors that you may have seen before. So we'll see how they come into play, particularly now with the sales, returns, and allowances. And later we'll look at these creditors in regards to purchases returns that we might make, things that we send back for credit or for cash back. So let's take a look at the bottom of the screen. And again, we have tabs that show various journals. We have a sales journal, and you see an entry there. We'll come back to that in a moment. We have a purchases journal, a cash receipts journal, and again, one entry there, and a cash payments journal. Nothing there yet. We have a general ledger with a number of accounts. Not all the accounts are there, just the ones that we need at this time. So we'll look at how those accounts in the general ledger are affected. We have an accounts receivable, one of our two subsidiary ledgers, and then we have an accounts payable ledger. So we'll be using these in the next few problems that we have. Let's go back to the sales journal. One of the things important with our example here that I'm going to walk through with you, the ABC bookstore will do the journalizing and do the posting of those entries every day. So every day there's a number of entries made in our journals, and we will post at the end of the day. Now, for our purposes, to make it very simple, we have just one entry in the sales journal, and we have just one that we saw earlier in the cash receipts journal. So we'll make it very simple. But if this is the only entry for the day of April the 1st, 2019, we not only will post what we can here, but also post the total for the day. Since there's only one entry, there's only one total, one simple entry that impacts the total. So again, let's walk through how this particular entry would be journalized and posted. This is a sale on account to St. Michael's High School, and they bought something worth $250. We credit sales, that goes up. We have to add sales tax to it. That happens in every entry when we sell something. So this is, in fact, calculated at a 5.75% sales tax rate, I believe. So we have that credited. And then the total, $264.38, is what the customer owes to us. So at the end of the day, let's assume nothing else happened here. At the end of the day, this needs to be posted. So first of all, we post this amount to the customer's account, St. Michael's High School. And we go to the accounts receivable ledger. And if we find St. Michael's High School here, you see that it has been posted April 1st. The reference is Sales Journal, page 2, and the debit, $264.38. So that shows how much that high school owes to us. The account number is put back into the Sales Journal, and that's posted. Since we are assuming we're at the end of the day, we also post the totals. So the total at the bottom is obviously the same. We only have one entry. So that has to be posted to the accounts receivable account, on the debit side. So you see 1130 there. So it has been posted. And if we look at the accounts receivable ledger and the general ledger on April the 1, we have an entry coming from Sales Journal, page 2, and there's your $264.38. So this account happens to have another entry in it. At the end of March, there was a debit balance of $190.35. So the total amount is $454.73. So again, 1130 goes back into the cash receipts, or into the Sales Journal. And we go to sales, post that total to the sales account in the general ledger. We need to find sales here. And we will see that on April 1, from the Sales Journal, page 2, there's the $250. And we'll look at this $42 in just a moment. But that's posted to the sales account, account 4110, back into the Sales Journal. And then finally, sales tax payable, $14.38. We look at the general ledger again for sales tax payable, and we need to look under the liabilities. There's sales tax payable, and we see that on March 15, we already had some money from an entry in the Sales Journal, page 1, and that sales tax payable was $10.95. So we haven't paid it yet. So it was a carryover balance. This is the current posting from April the 1st from Sales Journal, page 2, the $14.38. And we'll look at the $242 in a moment. So that account number 2150 goes back into the Sales Journal. So now we have all of this posted. So this should be done every day. Now there could be many transactions here, but each one is posted to the customer's account, and then the total goes to the general ledger accounts. So nothing was in the purchases journal. Cash receipts, again, you've had this before. We made cash sales on April the 1st. We have no account title. Nothing is needed here. We don't care who the customers are. They paid us already. They paid us cash. The document number is the cash register tape dated April 1. Nothing needs to be posted individually. That's why the slash mark. And then we have a sales credit of $42, and the sales tax that we charge to the customer or customers is $2.42, and the total cash that we received, $44.42. Again, because we do this every day, the total in this case happens to be the same, and we do need to post to the totals to these accounts. So we go to sales and we will credit. Again, that has been done, as we saw just a moment ago. Also on April 1st, from Cash Receipts Journal, page 5, there's your $42. So for this day, we have sales of $292. And we do the same thing with the sales tax. Sales tax payable has to be credited by $242, and we saw that a moment ago in the sales tax payable, and here it is coming from Cash Receipts Journal, page 5, the $242. So the total of $27.75, at some point we have to pay. We collect this from the customers, either when they pay cash or when they pay us on account, they pay us the sales tax. We then have to pay it to the government. We haven't done that yet, but that's the amount that we owe.